Financial markets have been jittery. Let's show you a couple charts as well as what you could do to cushion your portfolio. I'm Ron DeLegge with ETF Guide, and it's great to have you with us. So let's get right to it, beginning with our first chart. This takes a look at the big picture, major asset classes and ETFs tracking them since the start of the year. And as you can see, look at that. Commodities are leading the way, ticker symbol SDCI, one of the best broadly diversified commodities ETFs out there. We've talked about it so many times on this channel, and the importance of having multiple asset classes in your portfolio, not just stocks and bonds, but commodities, global real estate, cryptocurrencies. And look at this, commodities. Well, what are some Ron's favorite commodities? I love coffee. I love avocados, olive oil, cashews. Critical materials are pretty wonderful, like silver and copper. We need a lot of that. And plus coffee again. We'll throw in some wine. But again, commodities, take a look at your portfolio. This is an area that's doing quite well, up just almost around 9% since the start of the year. We've got other asset classes in this chart not doing so well. If you take a look here at Bitcoin, IBIT down just a nudge over 10%. We also have the U.S. stock market as tracked by the S&P 500 down by about almost 5%, SPY. We're going to take a look at the industry sector performance in a second. And then look at bonds, ticker symbol BND down about 2.5%. And, bonds have performed a little bit better. But one thing you need to remember is that bonds are not what we would consider a margin of safety asset that really protects you, because bonds can and do go down when stocks go down. And so what you really need to have is a stabilizing force inside your portfolio beyond things that can lose value. That even includes gold. Gold is not, again, what we would consider a margin of safety asset. But this is your big picture view since the start of the year. Interesting to see also real estate, global real estate holding up pretty good. Also pays a pretty decent dividend. I asked you guys earlier in the year, I think it was in January, which would be the best performing S&P 500 industry sectors in 2025. And we had almost 300 votes. This is what you said. Over 70% of you said technology would be the best performing sector. And then right behind, financials. Not too many votes for healthcare. Well, what is the results up until now showing? Have you been right or have you been wrong? Well, unfortunately, most of you have been wrong, because technology is one of the worst performing sectors in the S&P 500, down just over 11% since the start of the year. Consumer discretionary stocks, XLY, have also struggled as consumer sentiment has soured, and we're going to talk about why and some of the risks that it poses. But those two sectors, when you combine technology and consumer discretionary stocks, it makes up just over 30% of the overall S&P 500, and it is a rather large portion of the overall S&P 500 in terms of representation. And so that's why you see the S&P 500 performing so poorly, even though we have more sectors up than down. It's that these two big sectors have been really weighing on the overall index. Some of those other sectors that have performed well: energy, XLE, XLV healthcare, and then XLU utilities. And then, of course, XLP consumer staples. These are what we would call defensive industry sectors, utilities and consumer staples. I asked you a poll again, what is your favorite single stock to trade? So again, I wanted to get a pulse of you, our viewers. And it was almost split between Palantir, NVIDIA. We had a whole bunch of votes other with stocks like Meta and Microsoft. But I point this out because of the fact that we've had and have seen so many single stock ETFs launched over the past several years. Direction recently expanded their lineup. They added a couple of single stock ETFs, Berkshire Hathaway, as well as Palantir. And so I wanted to take a look at the specific performance of one specific stock, Tesla. Now, just keep in mind with these single stock ETFs, they offer, as you can see here, upside potential 2x or 200% daily upside exposure to however that stock performs in a single day, and then 100% daily opposite exposure or inverse 1x. And let's just take a look at Tesla. So this is a year-to-date chart. of Tesla, which has lost almost 35% in value. And as you can see from this chart, TSLS, which aims for 1x inverse or 100% daily opposite exposure to Tesla, has gained nicely, just over 37%. So far this year, the bears have been winning on the winning side of this trade. The bulls, TSLL, have not been doing or faring so well, down over 63% TSLL. And of course, that is a leveraged ETF, the bull 2X. So, not the trend now is not in favor of the bulls. But listen, this can change at any time, at any moment. And so we may see, if we see a hard bounce to the upside, you may see TSLL come back. But again, keep these tickers in mind. Those of you that may own some exposure to Tesla or any of these other stocks that maybe you have for example, one case study or use case would be if you've got an unrealized gain and you're not too keen on selling that stock for that gain and realizing tax bill, maybe hedging some of that position with an inverse ETF. That's just one idea for some temporary protection. So that's one use case. There are many others. Now let's talk about history. And markets right now are really trying to absorb a lot of stuff that's been going on. If we take a look at history, when you've had double-digit down years in the S&P 500, there's always been a negative catalyst. This was a nice little table here put together by Ryan Detrick, a technical analyst. And this goes back to 1930, and there's always been a catalyst for these big moves. In the 30s, it was the Great Depression. Then after that, in the 40s, it was World War II. In the 70s, you had a recession. And then, of course, in the early 2000s, you had the tech bubble, subsequent recession. 2008, of course, you had the great financial crisis. 2022, we all remember that. You had the Fed policy mistakes. You had inflation. All of this led to big moves in the S&P 500. So what about this time around? What are the catalysts for us right now at this moment? Well, really, when you look at it, it's policy mistakes, potential policy mistakes in Washington, D.C., and you're not going to get me to say the word. It begins with a T, but it rhymes with sheriff, and you're an antagonizing bunch. I know you want me to say it, but I'm not going to say it. You're not going to dupe me and trick me. You're not going to antagonize me. It rhymes with sheriff, starts with a T. And we have got an administration hell-bent on a hyper-nationalistic posture. And so far, the stock market, as the judge, as it always is, does not like what it sees one bit. And so, will this catalyst escalate or will it de-escalate? Well, right now, again, S&P 500 down about 5%. We're not quite yet in double-digit negative territory, but these are the catalysts that the market and that all of us are watching. So one thing that can help stabilize the investment portfolio, whether it's a retirement portfolio, IRA, whatever, 401k, is to have a margin of safety. I've talked about this so many times on the channel. We even have a playlist dedicated to margin of safety. In the 30s, Benjamin Graham, the father of value investing, he talked about margin of safety in the context of selecting individual stocks, and that if an investor was able to pick stocks at a valuation that was reasonable, it would give them a cushion or margin of safety. Well, I'm here to tell you that Ben Graham's margin of safety idea and strategy does not exclusively, it's not limited to how an investor picks securities. It applies to how the entire investment portfolio is managed. And it's just like a house. You have smoke detectors and deadbolt locks. It's the prudent thing to do. And a well-built house should have that to protect the owner, the inhabitants. And so the same goes for your investment portfolio, having an adequate cushion. And it complements the core portion of your portfolio and non-core. These are the three cornerstones of a well-built portfolio. Minimum safety standards. What is that margin of safety portion? When you carve that out of your overall portfolio, what does it do? Well, it does three things. It provides liquidity, It provides you with zero market volatility. That would exclude assets like bonds and gold and even Bitcoin or other cryptocurrencies. These have no place within the margin of safety section or portion of your portfolio. And of course, it has to be assets that give you 100% principal protection. And there's lots of choices in this area. And I haven't talked too extensively about it. Do you want me to? Should we get into this? Let me know in the comment section below. Do we need to talk about margin of safety assets? Do we need to review this? Do we need to go over this? We probably do. But again, hit me up in the comment section below and I could get explicit with you. And we could start really drilling down and discussing in a very extensive manner what it is that constitutes a margin of safety asset. It's all about winning, but not by losing, right? We're playing defense. Just that portion of your portfolio, right? The core and the non-core can still be at risk. And that's going to maybe over the long term offer you a higher upside. But the margin of safety is all about giving you a stabilizing force, especially in markets like now. And so you take a look at investment portfolios that do not have a margin of safety, an adequate cushion, they are very much at risk. If you are investing without a cushion or margin of safety, you should be very worried and concerned, especially if you're one of those that was what we call in the retirement red zone. If you're within 5 years of retiring or you've already retired, you definitely need a larger cushion or margin of safety. And you can see here a deep drawdown of 20% or more, your recovery on the upside needs to be that much bigger. And so having a margin of safety can prevent you from suffering these substantial types of losses. You're all about minimizing the size of the drawdown. And of course, there's many financial icebergs, right? It's not just the potential for upset markets. There's other things in our lives that are happening. We've got inflation, deflation. We've got potential illnesses and accidents that are always untimely. And then, of course, taxes, right? Taxes are always a risk to our financial well-being. Check out my book called Portfolio Architecture. I've got it linked in the description section below. How to build an architecturally sound investment portfolio. We talk about suitable assets for the core portfolio, the non-core, also suitable assets for the margin of safety. Those of you that like to read, it's also available as an ebook. Those of you that don't like to read, you can listen. What about the big money? What's going on with the big money? Well, here's our quick snapshot at the Bloomberg Billionaires Index. And at the very top, Elon Musk, he's lost a little over $102 billion of his net worth since the beginning of 2025. Man, that's a lot of bananas. He's still worth $330 billion, so he ain't crying poor. But I highlighted, you'll notice the industry sector, because I always rant on this, that you look at where most of the concentration of wealth is being made in which industry groups and industry sectors, and the runaway winner is technology. And so from an investor's perspective, that is where I think the focus should be, the orientation of the investment portfolio for the growth portion. You got to focus on technology. That's where the action's at. That's where the big money has made their money. And I don't think that's going to change as the world becomes more digitized, as we see AI, digitalization of money. All that is, you can wrap that up and put that in the technology sector. And so this, again, I think is a very important lesson for all of us from an investment perspective. ETF Guide TV, just by way of reminders everywhere. Beyond YouTube, we also could be seen on Apple TV, Roku, Amazon Fire, and then, of course, you can listen to our programs in audio format on Spotify, Amazon Music, and iTunes. Also, we've got new episodes of ETF Battles coming up, Shifting Energy, and others, so be sure to watch that and tune in. Do not miss it. So, how did you enjoy today's episode? Hit me up in the comment section below. And I hope some of the things that I shared on today's program will help to stabilize your investment portfolio. Having an adequate cushion, margin of safety, so crucial, especially in bumpy markets. But listen, there's lots of opportunities to make money. Of course, the ETFs are wonderful tools that give you the flexibility to take advantage of market volatility. We see assets like precious metals doing quite well. Also, we've got other assets like the buffered ETFs, which we haven't really talked about too much on the program, which have been getting lots of assets and gaining in popularity. Those have been executing and doing their job. And so that's an area that's that's been performing well. And then also the inverse performing ETFs, lots of choices beyond the single stock ETFs. You've got inverse ETFs on various market indexes, S&P 500, also bonds. So lots of choices there. So it's up to all of us to take advantage of these opportunities. Don't run and hide like a lot of investors or traders. They run and they hide or they panic. We don't want you doing that. Open up your eyes, look at the opportunities, and keep some dry powder. It's always good to have a little bit in your back pocket. Well, I'm Ron DeLegge with ETF Guide TV. Thanks for watching. We'll see you on the next episode.